Hello everyone and welcome back to Fun with Fitzy. We are on Chapter 9, Video 5, and this whole video is going to be on recognizing, recording, and valuing notes receivable. So we are going to do the whole thing here. So we know a little bit of notes receivable. This is not the first time we've talked about it. And we know a promissory note is a written promise to pay a specified amount of money on demand or at a definite time. The party making the promise is the maker, and the party to whom the payment is made is the payee. We talked about this in Chapter 9, Video 1. We also looked at this when we talked about notes payables when we were doing adjustments in Chapter 3. The formula to calculate interest for a notes payable or notes receivable basically is the face value of the note times the interest rate, which you need to remember is annual, so you need to multiply it by the time in terms of 1 year. So if it's 3 months, you would divide it by 3/12. And that would give you the interest rate for that time. So the interest rate specified on the note is annual. Remember that. So if it's a 5% note, then that is 5% if it was for a year. So let's talk about honoring notes receivables. When you honor a notes receivable, it's when you pay it back. So a note is honored when it is paid in full at its maturity date. So in this case, Wolder lent Hiley $10,000 on June 1st, and they accepted a 4.5% interest-bearing note due in 4 months on September 30th. So on September 30th, when the note is honored, they collect the cash plus the interest, and this interest would be $10,000 times the 4.5% times the 4 out of 12 months. That's how you get the $150. Okay, so that's the note, the journal entry to get your cash back after you had a notes receivable. And of course, the interest revenue is the account you're going to use to collect that interest. Now, remember, if there is a year end in the middle of this note, in the middle of these 4 months that you have, then you've got to do the adjusting entry to recognize the interest revenue in the months prior to that year end. When someone dishonors a notes receivable, it means they are not paying. So a dishonored note, it is a note that is not paid in full at maturity. And a dishonored note receivable is no longer negotiable. Okay, so by law. Since the payee still has a claim against the maker, so the payee is the person who loaned the money, the lender, remember? And the maker is the person who owes the money. Basically what happens is the balance that they owe in notes receivable, including the interest, gets transferred to the accounts receivable account. So here's the journal entry. So when they dishonor a note, they still owe you the $10,000 plus the 4 months worth of interest, but you convert it back to an accounts receivable. So now we've credited these accounts, one to recognize the revenue here, one to close off the notes receivable account. And then now this is to recognize accounts receivable now, because now they still owe you $10,150. Okay, so let's take a look at this handout. You guys should have this handout with you. And it has some of the information that we just covered off in some of those slides. So I'm going to go down here and let's look at this situation. So recognizing a notes receivable, let's look at this. Wilma Company receives a $1,000 6% promissory note due in 2 months from Bent Company to settle an open account. So let's talk about this. On May 1st, we need to recognize that note. So $1,000 is how much we expect to receive back. So we are converting, in this particular case, we are converting their accounts receivable to a notes receivable. As you see here, it said to settle an open account. Sometimes we just loan money. So in this case, it would be cash as a credit because we're giving them cash and they owe us the money. In either case, they owe us money. It used to be an accounts receivable. We're converting it to a notes receivable. They needed more time. So let's calculate the interest. So remember, our interest formula is going to be 1,000 times the 6%, and it's going to be due in 2 months. But on May 31st, when it's the year end, let's say, we have to recognize the interest. So we want to have 1 month of interest here, so 1/12. So if you do this math, 1,000 times 6% divided by 12 equals $5. So you've accrued 5 months of interest revenue. Remember, this is an accrual. This is the second type of adjustment because you've earned revenue, but you haven't received any cash yet. So we need to accrue this. So this is going to be the adjustment at the May 31st year end. However, so this journal entry here, 1, was to recognize the note. The second journal entry here is the adjustment at year end to recognize the interest that we've earned so far. And now on June 30th, when the note is due, we're going to collect it. So it didn't fall all on one page, so I'm going to move it all onto this page. So this is the third journal entry where you're going to receive payment. So the note receivable, as you recall, was for $1,000, and we've already accrued 1 month of interest revenue. So we only have 1 more month to do. So this interest revenue for $5 is the last month, June's revenue. And on May 31st, if you recall, we had, in the last journal entry, the second one, we had already accrued 1 month of interest revenue. So we had to clear this receivable for $5. So this was May's interest. So if you take this 1,000 plus the 5 plus 5, you're going to get $1,010 back. Okay, so that was recognizing, and that included honoring of a note here, and also taking the accrual into account because the year end fell in the middle of that 2 months. Now let's talk about valuing notes receivable. Like accounts receivables, remember we talked about valuing them using the percentage of sales, percentage of accounts receivable method. We do the same thing because sometimes we don't always collect the money. So I'm not going to reteach you all of this stuff, but I just want you to recognize that the procedures are all the same. However, instead of using an allowance called allowance for doubtful accounts, we're going to use an account called allowance for doubtful notes. Okay, so that's all you really need to know about valuing notes receivable. And we've already talked about honoring notes receivable in the video. So real quickly then, a note is honored when it's paid full. That's repeated what I just did a couple of minutes ago. In this particular case, there was a $10,000 note, and the interest on that note for 4 months was $150, and this note was honored. So we saw that in the video. And when they dishonored the note, we converted it back to accounts receivable, so we've already seen this already. So by now you should be able to journalize the recognition of accounts receivable, and that's from other videos, notes receivables and other receivables. All there. Thanks for watching.